Hi, this is Shane with The Rational Trader. It's Saturday. It's pretty late. It's 8:30-ish on the 26th. And what we're doing here is we've been running this experiment. Actually, let me change this. We've been running this experiment where we're taking the output of the machine learning system and using it to identify the common behaviors in a market, and then using that as a way to make decisions about what behaviors to look for and then actively trade. And we were running an experiment in January where we initially in December we looked at 6 months worth of data and looked for common behaviors across those 6 months. And the way we did that was we'd break it up into 4 weeks and then look for behaviors that had the highest profitability on the least amount of trades and throw out all the others, and then look to see if that showed up, that particular behavior showed up more than once. And of course, the more often it shows up, the better it is, right? And then in January, I changed it and said, okay, well, let's use less data and look for just the recent behaviors. And the reason behind that was it was related to struggling to find common behaviors in other markets, but also there was a concern about if by using data that goes back 6-7 months like this, if the character of the market changes, am I now out of touch? Okay. Thus far in January, I've been getting my ass kicked in CL compared to December, where I was nicely profitable. All right, so I could begin to draw the conclusion that there's a problem with this approach here. And what I have been working on is a different way to go about doing this common behavior analysis. And there's a number of problems with what I did. Problems is not the right term. It's just the way that it was done is extremely laborious. It takes a lot of time, subject to human error, but mostly just a lot of effort and time. And so rather than go through the exercise of tweaking all the things I need to tweak manually, I spent the time to write a program to do it for me. Okay, so let's talk about what that is, and then what the results are of using that program to identify what I want to do in CL moving forward. Okay, and then what we will see is that we're going to want to do the same thing on the other markets as well. All right, so you can see here if we want to focus our attention on this top section. This is what we're going to be doing. We're looking for common behaviors. We're not looking for recent behaviors. We want to see commonality, but we need to be able to tweak a few things. We have to be able to change the size of this bucket. Okay, so maybe 3 weeks is better, maybe 2 weeks, maybe 5 weeks. Okay, maybe it's better to do less buckets or less time, but with smaller buckets. So there'd be a bunch of these thinner 2-week buckets, say, something like that, but using only 3 months worth of data. Okay, so there's a bunch of things to do there, and there are a couple of other dials that we want to turn as well. Okay, so there's actually 3 total. So what we've been talking about, one, which is how big is that bucket. All right, so if I'm going to look for common behaviors, how big is my bucket? So here there are 4 weeks. If I say I want to see X number of occurrences of this particular behavior, then I need the larger the time span, the more likely it is that I'm going to see that behavior. And so we need to find the sweet spot between too big and too little. All right. There's another concept, which is for each behavior, and for members, a behavior translates into an action code. All right. So for non-members, what we're doing is we're looking at price action and order flow, and we're training a machine learning system on those two categories of data. It's extremely complex. There's 33 inputs to the machine learning system for every bar. Actually, 33 times 6. And it's looking for patterns, all right? And then we're analyzing the output. We're analyzing those patterns to see what is useful in a market, all right? And one of the things we want to do is be able to easily change the bucket size, okay? The other thing we want to do, I need to explain by looking at some actual data. So let's get that out. So the first thing that we do is we take all of the data for, well, I guess I need the sub still. So in this case here, this model was trained on data through June. So we never use a model on data that it has already seen. Okay, there's no predictive power in that because it's learned those patterns. Okay, and so what I have for CL, what I've built was a model through the end of June or mid-June, and a model trained on data through the end of September. So I've got two data sets that that use those two different models. I took the June model, and then I ran a program that said, okay, tell me, here's a file of every single bar between mid-June and last Friday, and tell me what you would predict for each of these bars. Okay, and that produces a file, and from that I can run simulations now that show me what would happen if I chose to trade a certain behavior. I have the same thing for a smaller data set. So the model's trained through the end of September, and then I gave that machine learning system the data from end of September through Friday and said, okay, tell me, what would you predict? Okay, that file looks like this. Here, let me bring it up. Let me bring one up. It looks like this. This is all the data for each bar. It goes on and on and on and on and on and on. All right, and at the end, what I come out with is that for this row, for this bar, I would have produced, the action would have been 0. Here the action would have been 286. Here the action would have been 286 again. That's the behavior. Okay, so now I've got this file. And what I'm going to do is, close that file. What I'm going to do is I want to do what's called a grid search. And what I'm going to do is I'm going to take every single behavior and run it just by itself in isolation. So every single behavior, if I chose this behavior in the long direction, what would happen? If I chose this behavior in the short direction, what would happen for every single one? Okay, and that produces, then I keep track of what those results are, and that's what this file is. I already have it open. Not that one. Trade actions. Okay, and so that's what this is. This is, okay, so for the time period of June 18th through 125, using the model built on data through 617, what would I predict? And if I ran only 141 longs, direction 1 is long, what would have happened? Here are the trades that it would have taken. Okay, and so I've got, it's a lot, right? Because that's 100 and something days worth of data, and it stops right there. Okay, and we do that for every single behavior in both directions. So we end up with something like, it's 3,836 actual trades. Okay, now what we want to do now is, given that I have got these dates, I can decide how to group it. All right, do I want to use a 4-week bucket? Do I want to use a 2-week bucket? Do I want to use a 3-week bucket? Okay. The other thing I want to do is, in that bucket, I want to sum it up. What was the total sum? So let's say my bucket was, monthly. So here's December. I would want to sum up the 141 longs. I'd get this number of minus 18. I'd count how many there are, how many trades there are. In this case, there's 10. And so I did minus 19 on 10 trades, and then I calculate, well, how efficient was that? And obviously the ones that are not showing a profit, we're just going to throw out. But the ones that do show a profit, we want to be able to compare to each other. And what we end up with is we're now going to take this file and we're going to run an analysis program on it. And that analysis program is going to give us some output that's really useful. Okay. So it's going to break it up into the buckets based on how I've told it how big a bucket I want. It's going to sum up the profit by behavior and direction. And then it's going to calculate how many trades I took for that behavior and then give me an efficiency ratio, which is the number of ticks divided by the number of trades. And so what we want is, we want ones that are like this down here, where I made 43 ticks on 3 trades and my efficiency ratio is 14. Okay. Basically, this turns out to be, average ticks per trade. Okay. All right. So here's another case. I made 50 ticks on 2 trades. That's 25. Okay. Now, we're going to break this data up into buckets. And so we have to tell it, how big is the bucket. But we also want to tell it what is the minimum efficiency ratio I'm willing to consider in that bucket. Okay, so we only want the best, but we also need enough to make it worth our while. So I could say I only want to see ones with, only show me cases where I've got an efficiency ratio of 25. But I would, as it turns out, you would take very few trades, okay, for that particular behavior. Okay, and so this ER threshold is an input. So bucket size, this is 28 days. Let's do an ER threshold of 3. Okay, I'm sorry, of 5, and the music is too loud. Okay, and then we'll do a frequency of 3. Frequency of 3 is, okay, well, given the buckets I've created, how many times do I need to see that behavior in a bucket in order to consider it a code that I'm going to use? So if I've got 6 buckets and I say 3, my frequency is 3, I need to see that code in 3 of these buckets, in other words, 50% of them, in order to consider it something that I would be willing to trade on. Okay. So bucket size, how big is, how many days are in each bucket? What is the threshold for the level of profitability versus number of trades? And then how many trades do I need to see? Or I'm sorry, how many occurrences of that good outcome for that behavior do I need to see in each bucket? Okay. And the way this is built now, I can vary these and get an idea for sort of how the market behaves. So if we ran this for let's see, let's run it for let's turn this one off here. So this file here is the file that's got the data from 618 through 125. So it's 7 months worth of data. We're going to say 28 bucket size, an ER threshold of 5, a frequency of 3. Okay, so we're going to run this. I think that's what I did. You can see it runs very quickly because it's actually not that much data at this point since it's all been consolidated. And this is kind of what you get here, right? In this bucket, here's this code, here's the direction, here's the ticks you made, here's the number of trades you made, here's the ER. What's going to happen next is I'm going to sort those by bucket by efficiency ratio, and then I'm going to throw away everything that's below that efficiency ratio, and then I'm going to count them. How often do I see it? And so what you see here is that in this particular case, in the long direction, the action code 296, the simulation made 145 ticks, and I saw that 4 times. So in 4 of the buckets, the total number of buckets was 7. Okay, so that means more than 50% of the time I'm seeing that trade show up in my time period. Remember, each bucket is just a time period. Okay, here, and what's kind of hidden here is what is the actual efficiency ratio. You can't see it now because it's been consolidated. What we said is it's a minimum of 5. Okay, so that means it had to have that minimum level of profitability versus number of trades. Okay, and so now with this frequency number right here, where did it go? We can have the system just sort of automatically spit out, well, what are those codes? Okay, and that's what's happening here. And this makes it very easy for me to just copy and paste this into the simulation program. Because all this has done for me is said, okay, here's a common set of codes to use based upon the criteria you gave me. But how does it actually work? Okay, so and it might take a little bit of thinking to understand this. What we're saying is that for this code here, for 296, we saw it 4 times show up in the greater than 5 ER category across 7 months. But what about the other 3 months? How did it do in the other 3 months? It may have sucked big time and you lost tons of money. So what you have to do is you have to actually run these codes across the entire data set to see how they actually perform. Okay, and what you'll find is that well, let's just do it and see. So let's just run this. We need to put these codes in to the replay program. This is the replay program that we originally used to run the grid search, and now we're going to tell it, no, don't run a grid search. Instead, just use these codes that I'm going to paste in here. Okay, so instead, for longs, just use that. And for shorts, just use this. Okay. And we're going to run this. This is going to take like 10 or 15 seconds. So let's run this. Oh, actually, we got to see what we're running it on. Let's make sure we're running on the right file. So we're running this on, okay, that's the wrong file for right now. We want to run this on 618 through 125. So for the entire 7-month data set here. Okay, so let's run that, and we're going to let that go, and I'm going to pause while that runs because I need to take a drink of water. It's interesting how the trading computer is slower than my development computer, unless I have a syntax error somewhere. Doesn't look like it. Yeah, here it goes, starting the loop. So I think this is probably the first time I've done it, so I had to load a bunch of libraries and things. All right, so here's our output. So using that analysis, and I actually zeroed in on the one that came out the best to start off here, but profit of 902. That's ticks, so multiply by 10 for dollars. Your total efficiency ratio is 2.84. Now think about that for a minute. What that means is we said we only want to see behaviors that have an ER of 5 or greater. But by the time you get done running those trades in buckets or time periods where they didn't do as well, you end up, the efficiency ratio drops. All right, so it's 2.84 on about 2 trades per day. So that's a good number. Here's the days seen, it's 158 days. The risk factor is turning out to be one of the most important things to look at now. So risk factor is basically how many times did I take a max loss day versus the total number of days in the data. Okay. And what I learned that in January here is that that number's got to be below 20, or just standard variation in the probabilities can give you a long stretch of unprofitable days. Okay, and so we got to keep this number as low as possible and still have enough trades to make it worth our while. but we can't have it too high. And 20 seems to be about the number. Like what I'm currently running in production is close to 30. All right, it's too high. Okay, so this is for the 7-month group of data. And what I did is I went and I varied. I varied these values up and down in isolation, and then up and down in isolation, and then up and down in isolation, until I found that sweet spot. Okay, which is what I'm showing you here. The actual whole series of runs are, I kept track of in order to understand what's better than others. We're going to come back to this and look at it in detail, but my point is it's very easy for me to change this to say, well, what if I went ER 6? All right, run this again, and now I'm going to get a different set of output codes, which I then just paste. And you can see there's a lot less because this is a pretty strict requirement. I require only behaviors where I saw an ER of 6 or better. And if I plug these in to the system, what do I get? All right, well, let's do that. There's the longs, here's the shorts. There's only 2 codes. All right, so I wouldn't expect to see a lot of trades. Let's run that. This is going to run a simulation now using those codes where we required a much stricter level of profitability per action, per behavior. Okay, and again, this takes quite a bit longer than my development computer. Pay no attention to the piano practice going on in the background. If I turn my music up to drown that out. So you can see here we get a profitability of 441, which is less than half. All right. You're taking just a little bit more than 3/4 of a trade per day on average. Your risk factor is basically non-existent. You're just never going to take a max loss day, is what that says. 6 times out of 158. Okay, but that's the price you're paying. Okay, ER is much higher as a result, naturally, 3.59. Okay, so the other thing to be doing is, changing. You could change in another dimension, which would be, well, you go ahead and keep that threshold at 5, but change the frequency to 4. I got to see it 4 times. Okay, what is that going to give me? All right, and what we see is that it basically almost nothing, and the reason is that you only have 7 buckets, and so you're saying I've got to see that more than 50% of the time, and it just doesn't. Just the way the markets work, it just doesn't occur that often, or often enough for that to work. Another approach would be, well, reduce the size of the bucket, and now you've got more buckets, so in theory, you could get more granular. All right, so let's go a 3-week bucket size with an ER threshold of 5 and a frequency of 4. And we actually sort of have to run this to see, well, how many buckets is that, and see if 4 makes sense. And it tells me here I've got 10 buckets. So I'm saying with a frequency of 4, I'm saying that 40% of the time I require that code to show up with a ER of 5 or better in a bucket. And that gives me a smaller set of codes to work with. All right, let's run this. I'm curious. I did it earlier and deemed that it wasn't one of the best choices, but for the purposes of this video, I want to give you a sense for sort of how to go about how I'm going about doing it. Okay, so if we run this now, we're going to get a number. And what we're going to find is that that first one I showed you is sort of the optimal one. A 28-day bucket, a 5-day ER, a frequency of 3 gives us a 902 with a reasonable risk factor. We're going to switch to, okay, well now let's take a look at the, a smaller amount of data. So that'll be the data from end of September through last Friday. So this shows 435 with a pretty nice risk factor, 10%. So, max loss days of 16 on 158 days seen. But your profitability is quite a bit lower. Okay, ER not that great, 2.5. You'd like to be closer to 3 or even more. Okay, trades per day about 1. All right. Now, what makes this interesting is that it kind of depends on what you're doing. If you're trading 6-8 markets, then this might be perfectly fine. You want to keep, you may be focused on keeping that risk factor down as low as you can because you're picking and choosing only the best from a bunch of different markets. Right now, I'm not at the point where I've got enough markets to do that yet, and I'm still kind of working through this process. So. The current best is what we did. So let's just do it again so you can see it. You get a sense for it. 28-day bucket, an ER threshold of 5, and a frequency of 3. Okay, and that's going to give us a set of codes. It's these codes here, which if we run, you'll see that 902 result. And that result is captured right here. Okay, so let's bold this. All right, and in particular, let's make this a different color. All right, so there we go. That didn't work out that well. There, let's do that. All right, on that risk factor. Okay. All right, now. Let's switch tracks here to the other case. Where did my PowerPoint go? Let's switch tracks here to just recent behaviors, which is getting less and less recent as time goes by. But this is a model that's trained on data through the end of September. So at this point, that's 4 months worth of data. Okay, and we're gonna go through the same process of tuning the bucket size and the ER amount and the frequency to come to what is the optimal set. Okay, and when we do that, so to do that, this is the wrong one. To do that, we need the simulation program up. And in this case, we're going to do the analysis on we need this file here. This is the file that has the trade actions from the end of September through Friday. Okay. And so my initial thought was, well, because it's a smaller time period, let's do smaller buckets. All right. We can keep our ER threshold at 5. Frequency is going to have to go up, but I can't remember what it would be. Let's go 4 and see what it gives us. Okay. Actually, at this point, I can stop printing this out since I explained ER. So let me get rid of that real quick. Let's run it again. Just save me some scrolling. All right. So here are it's a bucket size of 21. I have 5 buckets. I required 4. That's a pretty strict requirement. That's 80% of the time. So I get no codes. Okay. So let's change this to 3. That's still pretty strict. That's more than half the time. What do I get? I get something to work with. Let's run this and see. Okay. Not very many codes, right? When you consider how many there are. Let's put this in. All right. We have, whoops. A little too excited there. Let's put this in here. Okay. And now we need the short codes. Here are the short ones. And you can see what I've done here is I've just made it. It's still some manual work, but it's sort of an iterative logical thought process that's going on now, as opposed to me spending an hour to set up one of those and get the answer. So in a few seconds, I can get the answer. We need to make sure we're running against the correct file now. We want this file here, which is 0929 through 125. Okay, so let's run that and see what it gives us. And we're going to wait here. And I'm going to take a drink while we're waiting. We can listen to Dylan practicing. Or we can turn up Mozart. I can find the button. So that gives us, keep in mind now that this is less days than the other one. The other one was 158 days. This is 83 days. Okay. So 456, risk factor of 14.4. That looks pretty good. 3.83, I like that. That's a nice high number. Trades per day, 1.43. That looks pretty good, actually. Okay, that's not bad. Okay. What if we did something like... whoops, wrong one. If we changed it to 14, so 2-week buckets. Okay. Keep our ER threshold the same, but make our frequency higher. Let's just go to 4. Again, we're going to have to run it. I don't know how many buckets that is. So that's eight buckets. All right, that are 2 weeks in size, and I'm requiring that 50% of the time I see that behavior with that efficiency ratio, that profitability level. That gives me 4 codes again. How similar are they? The idea here is that by getting more granular, we may find things that we didn't see before. It looks like we got an extra code here by doing this. Okay. And then for the shorts, same thing. We've got 5 now. There'll be, whoops, what did I do wrong there? Let's try that again. I just copy pasted it wrong. Okay, now let's run this and see what we get. We had 456 and 14 last time, so I'll run all. So this will take a few seconds. And we're closing in here. I'm going to stop doing these examples and just show you the results of kind of what I came up with, and then we can make some decisions from there about what I'm going to actually do next week. Okay, I'm very pleased with the tool here that I have to make decisions. It was a lot of effort to build, but worth it. So this is less, 438. The ER is less. The risk factor is higher. So in general, that would be worse. Okay. Now, if we change this to, if we go back to here and we say, well, what about if I keep it at 28? Okay. But I change my ER threshold. I get strict. Whoops! I get stricter. I want to see only better trades, and the frequency I forget. I think it's 3. Okay. And again, we're running this on the data from September, end of September through last Friday. That's going to give me not the codes I'm looking for, so I did something wrong. Frequency equals 2. All right, so frequency equals 2. So what this says is, well, let's see how many buckets it is. So I'll run all. I've got 4 buckets, and my frequency is 2. So 50% of the time I need to see this code show up in a 4-week period, right? It's a 28 day bucket. And that gives me this set of codes. Okay. Now, as it turns out, this set is going to be the sort of the optimal that we found for this smaller set of data. Come on, stop it. Actually need to make this a little bit easier to do this copy paste. Okay. And now let's do the shorts, which are here. All right. And let's run this. And what we're going to get is a number that's pretty good. And we got to start thinking about, well, what does that mean? All right. So we're going to take this output and these codes and compare them to the other set of codes we got for the 7 months. So that's 616 across 83 days with a risk factor of 12, which is really good. Okay. 3.83, really a spectacular ER, just under 2 trades per day. Okay, so now this value 616 using this set of codes is in my not spreadsheet, but my here. So let's find it. 928 bucket 28 cutoff 6 frequency 2. Okay, so it's this one here. Let's make that bold. It's here. And it's here. Okay, so in all cases here, what I like the most, independent of this number over here, is that this risk factor is very low. So the max loss days in the simulation relative to the total number of days is small enough that it you have less probability of a long string of them in a row. And that's the problem. Even a small jump from, say, 20% to 30%, very quickly you can get a bunch of them in a row just because of the probabilistic nature of the environment, and you end up with a pretty painful week. So what we want to do now, though, is so we've got these two looks at the data. One is 7 months, and one is 4 months of data. And what I want to do is look at the codes. Okay. Well, actually, I need to explain one other thing that I did. This is 7 months of the last 7 months of data. Okay, I ran this set of codes on the last 4 months of data. Okay, because I wanted to see, well, okay, if I took this and I ran it on just the last 4 months, how would it do? And it does pretty well. It doesn't do as good as this, but what I was looking for was, well, how is it possible that most of this profit here is front loaded in the first few months, and then the first few buckets, and then the rest of it is all scratching or losing money. But that's not what this shows. This is 4 months worth of data. I would expect this is 7 months. I'd expect this number to be more than half if it's in somewhat of a linear distribution, and that's what it is. Okay, so this looked okay to me in general, all right, because of that. Then I went and did the 4 month alone trade analysis. So now let's do this. Let's take these codes for longs for the 4 month period and compare them to the codes in the 7 month period. Okay, and do the same thing for longs and shorts. And that's what this is up here. This here is the 4 month codes, and this is the 7 month codes for the longs. And what you can see is that within the last 4 months, 4 of the 5 are in the set of codes in the 7 months. So they've remained relevant or became relevant in the last 4 months, with just one new one popping up. Okay. On the short side, it's a little bit of a different story. On the short side, this down here are the codes from the 7-month analysis. And when we look at the codes for the 4-month analysis, we only see 2 of them that are common. So on the short side, in the last 4 months, new behaviors have shown up that are doing better, that don't show up in the 7-month analysis. And that makes sense to me when I look at this number here compared to this number here is 616. This is the profit on the analysis of the last 4 months. This here, 555, is using the 7-month analysis codes on the last 4 months. So this suggests to me that new behaviors have popped up to the tune of not that much, actually, when you look at it. 45 plus 16 plus 15, so 60 ticks, $600. Okay, the difference is that ER ratio. So that ER ratio is 3.8. So you're taking less trades to make that amount. You have to be a little careful now about are we optimizing to what's just happened recently versus looking at a longer period of time, accepting a smaller amount in order to have a profit curve that's smoothed out. Okay, so the amplitude of the gains and losses is lower, but hopefully steadier. Okay, so that's something to think about. I did think, well, what if I combined them? What would happen? Okay, so that's what this is. This is the union. Put these long, just basically add this long code to this group and add these 4 to this group and then run the analysis, run your simulation and see what you get. And when I do that on the last 4 months, I get a slightly better, well, not slightly, a 60 tick better number. Okay, so which makes sense because you're adding these in. The efficiency goes down, and that's because you're taking these trades here in the prior months also, and as a result, you're taking more trades that aren't necessarily working out as well. If I had to, when I look at this 4-month analysis here, all right, with 616 and a risk factor of 12, and the 7-month analysis here with 902 and a risk factor of 14, both of these appear conservative to me. Okay, I wouldn't say that the 7-month is conservative and the 4-month is aggressive, which is kind of how we were thinking about it before, because the 4-month analysis, it was 3 months at the time, didn't look so much at commonality as it did just give me the highest rated trades recently. Okay, by doing the union, I'm a little concerned that by doing this 4-month analysis, I'm a little concerned that we are going after behaviors that just happened most recently. So there's a big problem with traders where they trade what happened yesterday, and I want to avoid that. So I'm tending to think that it's best to stick with this set. Though the reality is, what the data is very clearly showing, either of these would be fine. Okay, the union doesn't look okay. So now, with that in mind, here's 2 choices, right? A 7-month analysis with actually quite a few codes, and then a 4-month analysis with a lot less codes. Okay, a lot less behaviors. There's a 6 and 5. There's 11 here. Here there's almost double that. Okay, here's the big question. The last 2 weeks I've done really poorly in CL using this analytical method. This one here, recent behaviors. How would the system have performed over the last 2 weeks if I used both of these behaviors, or I'm sorry, both of these sets of behaviors. Okay, so to do that, what we need to take the model. Actually, let me bring up the dates here. So for the last 2 weeks would be the 14th through the 25th. So I need the model from the 11th. And then what I want to do is I want to take the data for these last 2 weeks and apply the model from the 11th to it to get the predictions the system would make. And then from that, run an analysis using these, run a simulation using these sets of codes and these sets of codes. Okay, how would the system have performed? Now, before I show you the answer, make a prediction in your mind. What do you think would do better? The 4-month analysis that appears to be taking advantage of more recent behaviors, right? So you can see a bunch of short action behaviors showing up there that aren't in the 7-month codes. Or would you think that the longer analysis, presumably steadier set of codes would do better? Okay, what's your prediction? So what I did is I went off and I created this file, which is from January 14th to January 25th. Show me the machine learning system, tell me what you would have predicted. And then from that, I can now apply these codes to this file as a simulation and get a number for the last 2 weeks. Okay. All right. So you've thought of your answer. Here's what actually happens. Against the last 2 weeks, if I take the 7-month set of codes, I made 540 on 26 trades. ER of 2.0. Risk factor of 30, fairly high. 3 max loss days out of 10. Okay. If I use the 4-month number, I made less, 33 against 18 trades. A worse ER ratio, 18 trades total. So what is that, trades per day? Just under 2 trades per day. Risk factor of 20, much more in line with what I'd like. What that means is I took 2 max loss days instead of 3. All right. I found this answer surprising. I was expecting the 4-month analysis to do better over the last 2 weeks, simply because it's more current, or it would seem more relevant. Certainly, either of these I would have been happy with, given what actually happened, which was I got my ass kicked by the markets this week. Okay. And so for members, you have a choice in front of you on what it is which sets of codes do you want to use. All right, I can't consider either of these aggressive sets of codes. They're both definitely in the conservative category. Across a statistically valid set of data, the risk factor is excellent. It's well below 20. Same thing here. I think it comes down to a matter of personal preference. Okay, what I'm going to do starting Monday, I'm considering my January experiment over, and I don't want to say it's a failed experiment, because by nature, an experiment, you don't know the outcome. So it yielded really good data for me in that the method that I was using, this recent behavior analytical approach is not effective, or certainly was not effective. And though I would normally say 2 weeks is not enough time to make a decision in a probabilistic environment, by going back and doing the work that I've just done, it's pretty clear that either of these approaches would have been much better. Okay. I'm sorry, here, against the last 2 weeks. Either of these approaches would have been much better. And the logic behind how I arrived at these sets of codes is in my view, very sound. Okay, so what I am going to do is, for members, I'll put this data into the spreadsheet that I put out, all right, and very clearly label what's the 7-month analysis versus the 4-month analysis, and I'll put that out. Okay, and then you can just update your codes in your spreadsheet. There's no chart book changes. I'm going to be using the 7-month data. Okay, that's for CL for next week. I'm likely going to put everything else into SIM because I want to do this analysis in this way, very methodically, against all the other markets before I continue trading them live. I like what I did here. I like the way it worked out. I liked what I discovered, and I want to do that for gold and the yen and 6E. All right, but it's non-trivial to do the setup. So basically, what I mean is creating these files that are necessary to do the grid search and then do the analysis. That takes a fair amount of effort. Once you have them, you can just continue to reuse them. So, once I have the model for 618, it's relatively simple to do a different analysis on this data. I guess it's not that difficult really to then add in, say 2 weeks from now, do it again. This time on would be 7.5 months worth of data. We'll have to figure out what's the process longer term. I don't think that continually adding more data to that analysis is going to be useful. I think there's a cutoff there, like 6 months back or 7 months back or 8 months back. But we have this model here, so we can continue to look at them both in the same way that I looked at this both. So let's say I decided I wanted to do every month, redo the analysis using the last 6 months worth of data. I could do that, but then also do that analysis on data that goes back further and then compare the two in the same way I compared this to see how much drift there is or how much, what changes we're seeing in the market. Okay, all right, so this is a long video, and this is because it's the culmination of a lot of work. In fact, in many ways, it's the culmination of almost a year's worth of work working with the machine learning system in a live environment. Okay, so there was a year of development effort before that, and since then, we've been working live in a pretty volatile environment. We've switched out to a less volatile environment, but in the process we've learned a lot more about how to be choosy about where to enter, and then how to be choosy about understanding what behaviors work better in each of the markets. Okay, so that's it for today. It's almost an hour long here. I hope you found this to be worth your time. For members, as I said, I'll put out the spreadsheet that has the codes in it so that you can just copy paste into your spreadsheets depending upon the choice you make, whether it's the 7-month analysis or the 4-month. And then the models themselves will be coming out later than usual because I've spent so much time on this. I didn't have time to actually pull them down. They're built, but I need to get them off the cloud services and formatted and stuck out where they need to go. Okay, so I don't think that's going to happen until late tomorrow afternoon, late Sunday afternoon, because I'll send an email and let you know. Okay, that is it for today. If that's not long enough, take care, and I will see you next week. Good trading.